$73. That is the number institutional money quietly circled on the chart while retail traders panicked their way out of silver positions this week. A 5% single-session collapse sent shockwaves through the precious metals complex. And if you watched the financial headlines, you heard all the usual explanations. Profit-taking, correction, healthy pullback. Every single one of those explanations is wrong. What actually happened on Tuesday was a liquidity event, not a fundamental repricing. Leveraged players across multiple asset classes got margin called simultaneously, and they dumped their most liquid holdings to raise cash. Gold, silver, platinum, palladium, everything hit the floor together. Not because anything changed about the supply-demand equation, because someone, somewhere, needed money fast. And paper markets gave them the exit. Now here's what matters. While those forced sellers were flooding the market with contracts they never wanted to close, a different group of participants stepped in at precisely the $72 to $73 range and started accumulating. Not trading, accumulating. That distinction will define the next 12 months of this market. Traders close positions in days. Accumulators are building positions they intend to hold through an entire structural cycle. And the timing of all this could not be more loaded. Within the next 48 hours, 2 of the most consequential data releases of the entire month will hit the tape. The FOMC minutes from the January meeting drop today, and Friday brings the Personal Consumption Expenditures Report, the Federal Reserve's actual preferred inflation gauge. Every institutional desk on the planet is parsing positioning right now, and what the data reveals will either accelerate or delay the rate cut timeline that drives trillions in capital allocation decisions. This is the setup most people are missing. They see green candles after red candles and call it a bounce. What's actually happening underneath is a repositioning war between forced sellers and strategic buyers, playing out against a backdrop of maximum uncertainty. 2 data bombs, a structurally deficient commodity market, and a window of thin liquidity with Chinese buyers completely absent for the Lunar New Year. To understand why this 48-hour window matters more than the last 2 months combined, you need to see the full architecture of what's driving precious metals right now. And it starts with a mechanism that most financial media either does not understand or doesn't want to explain. The precious metals market operates on a fundamental contradiction that few investors fully grasp. Gold and silver are physical commodities with hard geological supply limits, yet the overwhelming majority of their price discovery happens on paper markets where the supply of contracts is theoretically unlimited. When you see silver's spot price, you're not watching the physical metal get repriced. You're watching a derivatives market where paper claims on metal outnumber actual ounces by orders of magnitude. This gap between paper and physical is the fault line running beneath everything we're about to discuss. On the physical side, the numbers are straightforward. Gold recovered to roughly $43.21 per ounce after Tuesday's bloodbath. April delivery futures settled just under $4,500. Silver snapped back 2.4% to approximately $75.60. Platinum gained over 2%. Palladium climbed nearly 2.5%. The entire complex moved in lockstep, which itself tells you this was a liquidity-driven event, not a metal-specific one. When everything drops together and everything recovers together, the common variable isn't fundamentals, it's capital flows. The technical structure underneath silver's recovery is particularly revealing. The bounce initiated precisely at a confluence zone between 72.86 and the 72.19 horizontal support that has been tested multiple times in prior sessions. Confluence zones matter because they represent price levels where multiple forms of analysis point to the same conclusion. Institutional algorithms track these zones. Large buyers place orders at these zones. And when price arrives and holds, it confirms that serious capital considers this level of floor worth defending. If this kind of structural analysis resonates with you, if you're someone who wants to understand market mechanics rather than chase headlines, hit subscribe and like. Because the next section takes this framework and applies it to a setup that institutional desks are watching with extreme attention right now. Above current prices, the resistance architecture is equally defined. 78.73 aligns with the descending trend line from recent highs. The 50-period exponential moving average hovers near 79.50, acting as a dynamic ceiling for any relief rally. And the threshold that would confirm a genuine resumption of the larger bull trend sits at 82.45. Reclaiming that level with volume opens the path toward $90 and beyond. But the market has to prove it can get there, and 2 data releases stand directly in the path. The FOMC minutes and PCE report represent a binary fork for precious metals. The Federal Reserve's internal debate has spilled into public view in a way that rarely happens. One senior Fed official recently suggested multiple rate cuts remain likely this year if inflation continues trending toward 2%. Another openly stated that cuts may not come for some time given persistent inflationary risks. These aren't subtle differences in phrasing. These are fundamentally incompatible policy outlooks from people who vote on the same committee. The minutes will reveal where the balance of opinion actually sits, and the market will move accordingly. Here's the layer that transforms this from a routine data week story into something structurally significant. The Silver Institute's latest projection calls for a 67 million ounce supply shortfall in 2026. If that materializes, it will mark the 6th consecutive year of the global silver market consuming more than it produces. 6 years running. Virtually any other commodity on Earth, a deficit of that duration would have already triggered a dramatic price adjustment. Silver's escape from that reckoning has depended entirely on above-ground inventories accumulated over prior decades, being steadily drawn down to fill the gap. But drawdowns have a mathematical endpoint, and that endpoint is getting closer with each passing quarter. The demand side of this equation is undergoing a transformation that has not been fully absorbed by the market. Global solar installations are projected to reach a record 665 gigawatts this year. The solar industry alone now absorbs nearly 20% of total annual silver production. Manufacturers have made meaningful progress, reducing silver content per panel through efficiency innovations, but the explosive growth in total installations overwhelms those savings entirely. Then add electric vehicles. Then add the massive build-out of AI data center infrastructure, where silver's unmatched electrical conductivity makes it essential for cooling systems and high-performance connections. The demand curve isn't just growing, it's structurally accelerating across multiple sectors simultaneously, and the supply response to all of this demand, essentially paralyzed. Over 70% of global silver output is a byproduct of mining zinc, copper, and lead. Silver miners can't scale production in response to higher silver prices because the mining decisions are governed by entirely different metals. Economists call this supply inelasticity. Silver prices could double from here and production would barely budge because the mines that produce silver exist primarily to produce something else. This is the structural trap that makes silver fundamentally different from almost every other investment asset. Now, layer the current tactical environment onto this structural backdrop. Chinese markets are shuttered for the Lunar New Year. China is the single largest physical gold buying market globally, and its absence thins the order book considerably, making prices far more susceptible to aggressive moves by paper market participants. Large players who want to mark prices lower, or accumulate at lower levels, have a structurally easier time doing so when a major physical buyer is sitting out. This isn't speculation. The documented pattern of significant price moves during periods of reduced global participation goes back decades. The geopolitical premium embedded in gold is simultaneously shifting. Diplomatic developments between the United States and Iran on nuclear negotiations, combined with the first sessions of Russia-Ukraine peace talks in Geneva, have compressed the risk premium that drives safe haven flows into precious metals. Part of Tuesday's collapse traces directly to this premium deflation. But anyone who's watched geopolitics for more than a news cycle knows that progress and resolution are vastly different things. Premiums compress on hope. They expand again when hope meets reality. So here's where all these threads converge into a picture that most market commentary isn't assembling. Silver ETFs recorded net inflows of 15 to 20 million ounces so far in 2026, despite falling prices. Read that again because it contradicts everything about normal market behavior. When an asset's price drops, ETF investors typically redeem shares and outflows accelerate. That's the pattern for momentum-driven capital. And what we're seeing in silver is the opposite. Capital is flowing in as prices fall. That's the signature of value-driven accumulation by participants who view current levels as a long-term entry point, not a failing trade. Major institutional forecasters have put numbers on the table that make the current price look like a disconnect. Analysts at prominent banks are projecting an average silver price of $81 per ounce for 2026. If the current price sits in the mid-70s and the full-year average is expected at 81, simple arithmetic tells you silver needs to spend considerable time well above 81 to offset the period spent below. Either the institutional consensus is fundamentally wrong, or the current price represents a significant discount to where silver is headed. And given the 6-year deficit, accelerating industrial demand, and inelastic supply we've already outlined, the burden of proof falls heavily on the bearish case. There's a question embedded in all of this that deserves genuine consideration. If the structural fundamentals are this clear, why does the price keep getting knocked down? What mechanism allows a commodity in its 6th year of deficit to trade as if supply is abundant? If you have a thesis on that, put it in the comments. Some of the sharpest analysis on this topic comes from the people watching these videos, and this is the kind of question worth thinking through collectively. Now, intellectual honesty demands presenting the legitimate counter-arguments. The gold to silver ratio has climbed above 66 and continues expanding. If that ratio pushes back toward 80, which is where it sat several months ago, the math at current gold prices implies silver near $60. That's not fear-mongering, it's arithmetic. Dollar strength has also reasserted itself this week as weak economic data from the European Union and the United Kingdom drove capital toward the greenback. A stronger dollar mechanically pressures all dollar-denominated commodities, precious metals included. The FOMC minutes and PCE data could deliver a hawkish surprise that pushes rate cut expectations further into the future, strengthening the dollar further and creating additional headwinds. Technical support at 72 could break, opening a potential slide toward the 64 to 65 range where February lows were established. None of these risks are trivial. They're real, quantifiable, and must be weighed honestly against the bullish thesis. But here's the distinction that separates structural analysis from short-term noise. Every bearish factor just listed operates on a timeline of days to weeks. The bullish factors, physical deficit, industrial demand acceleration, supply inelasticity, institutional accumulation, operate on timelines of months to years. The question isn't which set of forces is real. Both are. The question is which time frame you're positioning for. The economist Hyman Minsky spent his career documenting a paradox that applies directly to this moment. Stability breeds instability. During periods of calm, leverage quietly accumulates beneath the surface until the system becomes fragile enough that a single catalyst triggers cascading liquidation. Charles Kindleberger mapped the same cycle across centuries of financial history. Expansion, euphoria, insider profit-taking, then panic as forced sellers overwhelm the market. What we witnessed this week in precious metals carries the fingerprints of that final stage, not because metals are in crisis, but because they got caught in the cross-currents of a broader deleveraging event that had nothing to do with their fundamentals. This distinction is everything. When an asset falls because its value proposition deteriorated, the decline is informational. When an asset falls because leveraged players in entirely different markets needed cash and sold whatever was most liquid, the decline is mechanical. Mechanical declines create dislocations between price and value. And dislocations, for those with the framework to recognize them and the discipline to act, are where generational positioning happens. Silver currently sits at roughly 0.03% of total global wealth allocation. During the 2011 peak, that figure was 0.06%, still a rounding error by any institutional standard. The room for capital rotation into silver from traditional financial assets remains enormous by historical measure. Central banks worldwide continue accumulating gold at record pace as part of a multi-year diversification away from dollar and euro reserves. The structural forces pulling capital toward hard assets haven't weakened. If anything, each passing month of deficit, each new gigawatt of solar capacity, each new data center breaking ground tightens the physical constraints further. The next 48 hours will produce volatility. The FOMC minutes will move markets today. The PCE data will move them again Friday. And within that volatility, the same dynamic we've already identified will repeat. Forced sellers driven by margin calls and algorithmic triggers will create price dislocations. Strategic buyers will use those dislocations to build positions. And the underlying physical deficit will continue quietly narrowing the gap between available supply and relentless demand. Remember the opening of this video, $73. That's the level where institutional capital stepped in while retail capital stepped out. That divergence between those who react to price and those who respond to value is the wealth transfer mechanism that operates in every market, in every cycle, throughout every era of financial history. The mechanism doesn't change. Only the names and the numbers change. The system that prices silver was built for a world where industrial demand was stable and investment demand was cyclical. That world no longer exists. Demand is now structurally accelerating from multiple directions, while supply remains locked to the production economics of other metals entirely. Whether that tension resolves this quarter or next year, the math doesn't bend. Deficits accumulate, inventories deplete. And eventually, the paper market has to reconcile with the physical one. It always does. The only variable is timing, and time is the one resource the deficit is steadily consuming. Position accordingly.